Welcome back, traders and investors. We have a special guest on the line here. That's Adam Sarhan, and he's founder and CEO of Sarhan Capital. Adam, how was your 4th of July?
It was excellent. How about you?
Good. Little fireworks, little swimming, a lot of barbecuing, the traditional stuff. So back to the markets here. Could you tell us a little bit about your firm?
Absolutely. We provide investment advisory services for institutional and individual investors across all spectrums. We have three main services. We offer asset management, we offer institutional advisory services, and then research. So to speak about each one individually, asset management obviously would be separately managed accounts. We manage the money for you. The institutional advisory service is via analyzewallstreet.com. And there we have a niche market with small and medium-sized professional asset managers, whether they're RIAs or small mutual funds, what have you, under the 250, 300 million mark. They typically don't have access to research from the big banks, but they need good ideas. So they come to us, and then we have a relationship with them. We offer them good ideas. They like us. They pay us. They're happy. Great. If they don't, they can cancel anytime. There's no contracts. And then over time, developed the need from the individual level and the smaller level. So we offered findleadingstocks.com, which has just blown up into a huge thing where we offer it's a weekly stock market research note and intra-week updates, and we give specific entries and exits getting in and out of leading stocks.
We got to talk to you about this website. I just went there right now here, Adam. What stocks, what's going to be the next leaders here? Because we have been on this extended bull run here. I was just saying on the show, somebody tweeted out that we've went 1,000 days without having a 10% correction here. So we're looking for the next leaders to continue to drive us higher. What's on your list there?
Yeah, absolutely. There's a lot of leading stocks. The market, there's a few things going on. As far as the next hot stock, always look for new IPOs. So you have Grub that just came out that's forming a nice IPO base. Market, MRKT is another nice IPO base that's forming, sitting very, very quietly. It's forming a bullish 3 weeks tight pattern, ticker symbol MRKT. And over the last 3 weeks, if you look on a closing basis, the closes have, 2 of those weeks have been identical, and 1 week was 3 cents off. So what happens is once you see an IPO come out, typically it's very healthy. Google did it, all the big guys back in the 80s and 90s did it as well. You see it move sideways for a few weeks, a few months, build a pattern or build an IPO base, and then blast off and begin a huge run. And a lot of the next generation of big leading stocks tend to do that. So we always look for new merchandise. And then existing merchandise, the Apples of the world, the Googles, they're out there. And then what we do with our service is we offer advanced entry points, getting you in early ahead of the crowd. So a good example would be most people try to buy breakouts. You look at a base, whatever the base may be, whether it's a cup with handle or head and shoulders or a flat rectangle base, what have you. Most people buy the breakouts. The problem is that I've noticed through time is that most breakouts fail, or the breakouts negated for a small amount of time stops you out and it takes off without you.
Right.
So after several years of painstaking, going back and forth, I just erased everything. I started from scratch. Said, okay, let me just seek the truth, like Dalio says, and let me look for what works. So I developed a system which I call advanced entry points. I have free webinars on findleadingstocks.com which go over the methodology in detail, and they're on YouTube as well. But basically, the underlying notion is that you want to think like an institution. And when I say institution, I mean a successful institution, a successful trader. Excuse me. So what you want to do there is you want to get in early. So what are these big institutions? If you had $1 billion under management or $10 billion, whatever the number is, and you had to accumulate a position in a stock, you can't just buy a breakout. It's just not going to work. So what these big players do, and a lot of them are our clients, we see them and we do it as well, is we go in and we build the base. So instead of buying after resistance is broken on the upside, you buy the breakout, we're trying to buy closer to support. Why? Because number one, it gives you, no one else is doing it. That's number one. So you get in way ahead of the crowd. And then by the time it does break out, you have a huge cushion. And I'll give you an example in a second with Netflix or Apple or any of these other guys that we just recently took advantage of. The second advantage is that you have a clear exit point if you're wrong. So instead of buying above resistance, if you buy closer to support or a downward trend line within the base, you're able to get out if support is negated. And that's extremely important because now there's material damage on the chart. Whereas if you just buy a breakout and the breakout's briefly negated and then it takes off without you, there's no damage. I mean, so what? The breakout was negated, big deal. You're stopped out because you have a 6 or 7 or 8% loss or 10% loss, but the stock's acting perfectly fine. It's still above its 50. It's still above support, ... So getting in near support is really important. And the third advantage allows you to take a bigger position. So when the stock does run, you really you can sink your teeth into it and participate on the upside.
Okay, so I'm looking at your different sites here, and it seems like the research on the findingleadingstocks.com and Market Valor is kind of the driver for the other two, because if you don't have the research, you can't make the recommendations to the institutions and as well as the smaller advisors. So are you using a top-down technical approach, or do you start with fundamentals? Is it equally rated? What's in your secret sauce?
Yeah, I would recommend everybody that wants to learn more, visit findleadingstocks.com. There you have free webinars. You have the research. You can definitely try it out. The secret sauce is a combination of fundamentals and technicals with a heavy reliance or focus on technicals, but with a twist. It's not standard technical analysis. Everybody focuses on technical analysis and fundamental analysis. So I've developed my own investment system called DAMP. It's also on findleadingstocks.com. And the P in DAMP stands for psychological analysis. So what I've learned is, I have a 90-10 rule. So basically 10% of what you learn and the fundamentals get in here, technicals get in there, whatever the case may be, anyone can learn how to trade stocks. The real difficulty in this business from both institutional and individuals alike is the psychology. And that's where I focus most of my efforts on. So how you think matters more to me than what your system is, because most systems work if you're able to, actually do them. The problem is the implementation. People have a very difficult time when the bullets are flying, getting out of their own way. And after working with thousands and thousands of people, both individuals and institutions, I've noticed that the execution, being able to pull the trigger while the market's open, is where the difficulty lies. So I've developed a system which removes the psychology part of it out of the equation. And I've studied why most people lose money in this business is because they're making emotional decisions, not rational decisions. Even though we all think we're rational, we all think we're intelligent, there's something called the optimism bias, in psychology, which means that if you ask yourself, you're a good driver. Almost everybody, you have a room full of 2,000 people, almost everyone's going to raise their hand. It's statistically impossible for everybody in that room to be a good driver. Or, ask yourself another question. Are you good looking? Are you kind? Are you modest? Are you honest? Whatever the case may be. Or you ask newlyweds when they get married, what's your chances of getting divorced? The answer is almost always zero. Meanwhile, statistically, 40-50% of people in the Western world get divorced. So there's that optimism bias. Are you a good trader? I have room. I speak all the time. I'll be at the Plaza in New York on the 2nd of August, and you can also sign up there as well on Find Leading Stocks. But, I ask a room full of 50, 100 traders, how many of you are good traders, above average traders? How many of you are great traders? Everybody raises their hand. No one says, oh, yeah, I'm a really bad trader. So when you look at yourself, you can always say the guy next to me is bad. He's a bad driver. He's a bad this. He's a bad. But people naturally have a tendency to say, oh, yeah, I'm better than average. And that false sense of reality is a distortion. So what I work on is a lot of what I do is saying, okay, I know that I'm human. I know that I have strengths. I know that I have weaknesses. So let me focus on my strengths and isolate my weaknesses. And then a lot of what I do is on a weekly basis, my decisions are made when the markets are closed. And then during the week, you just simply execute the plan. And that's exactly what we do with Find Leading Stocks.
No, it's funny. You mentioned the psychology of things. I had a swim coach for the longest time, and he used to always say 90% of swimming is 50% mental. And it's true.
That's so true.
Yeah, and you gotta have the right mental attitude, because if not, things could really be could affect your trading. You said you had some stocks that had fallen into the pattern that you like, with a forming the base. I pulled up this one Pfizer here. I was looking at this, and I believe it had 26 to 30 lows within the same area. Identified that. I figured, hey, institutions were ganging up here at this level. I knew my stop out was under the $29 level if it took it out. The market helped me out. Could you please give us some other examples of issues that you've been in recently?
Yeah, absolutely. The best example just recently is Netflix. The service is up about 35% on the stock. We bought the stock, I think it was back, let me get the exact date. Yep, it was middle of May, late May. Right when Netflix was breaking above its 50-day moving average. And what happened was, let's just rewind the clock for a little bit. The biotechs, the momentum stocks, and the growth stocks, and Netflix tends to be in the latter two, the momentum and the growth, had a massive correction back in March and April of this year. And Netflix was no example. I mean, it was Netflix, Facebook, Google, the list goes on and on. But all these momentum and growth stocks, they're massive, massive leaders. So I know these stocks are leading. So we had a nice run in those stocks last year, and then up until even early this year, January and February, had big gains. And all of a sudden they start, breaking down. Technical support's broken. Okay, great. So we exit. We have nice gains, nice big cushions across the way. We had a 30% move in Tesla. We had, gains across the board. So now what we're waiting for is two things. We're waiting for the market direction, whether or not the market was topping or not. Clearly it was not. It was just building a nice 5-month base to consolidate last year's rally, which was very healthy. And then also what I kept to focus on back in March and April was these leading stocks. How are they acting? And it's normal. I have what's called the know your customer rules. One of the, the rules in this business, if you manage money for other people, it's and part of the fiduciary responsibility, you have to know your customer. So you put them in investments that are appropriate for their investment tolerance and their risk behavior, ... So what I say is know your customer rule, but I apply it to the stocks. So these big leading stocks, whether it's Netflix, Google, Priceline, what have you, they're prone to move, and they move in a violent fashion. So when you have a Netflix pull back 30, 40%, Facebook did the same thing, Google, Priceline, I'm sitting there waiting to get back into these stocks. Number one, I'm locked in a profit, so my mental capital that you spoke about before I came on in the segment earlier is preserved. So you don't have to worry about taking big hits or big losses. And then the second thing is when everybody else is selling into that whole, oh my God, the market's topping, we're going to, back down to zero. My viewpoint is no, this is actually very high quality merchandise. It's on sale for whatever reason, however you want to internalize it. I just look at it as a normal pullback or correction within a very strong advance. And then the second you started seeing those bottoms happen in Apple and Netflix and all these other stocks, I'm sitting there like a hawk ready to pounce. And then Netflix forms a little 2 or 3 week bottom pattern. And then all of a sudden, it starts consolidating those moves in tight ranges and then blasts off above its 50 and gets back above its 200-day moving average. The second it broke out of a downward trend line within that base, we bought it. So we bought the stock, and then the stock blasted off, and this has just been near perfect example of what we do. We bought it the second it broke back above its 50. It broke out of a little bit of a sideways base and a little downward trend line. And then 5, 6, 7, 8 weeks later, the stock's back at new highs, and then just last week, you talked about the fireworks. We had fireworks on Wall Street was the title of my weekend piece, saying that, boom, the stock broke out. And now everybody that would be a classic breakout technical analyst would be all over it, saying, oh, I'm buying the breakout. Meanwhile, you could look at the 50-day moving average in Netflix, and one could argue the stock's extremely extended right now just because the stock closed on Friday at 472 and the 50-day is 405. That's 70 points away. So if you're buying that breakout, which there's nothing wrong with it, if people like doing it, that's fine, but it just wasn't working for me. So the breakout would have been at 458, which is 50 points above the 50-day moving average. So not only was I able to get in nice and early at 436, I now have a huge cushion. Everybody else is buying this breakout. And if this breakout does work, like traditional technical analysis tells you, then great, Merry Christmas, we're off to the races. And if it doesn't, we're not going to get stopped out. If you have a nice little pullback and then it works, it's even, all the more power to it. And the same thing with Apple. That's another example. We're up about 20% there as well. We got in nice and early when they reported earnings. They had a big breakaway gap, boom, and then it just took off.
So what is your signal to actually, get out of these positions? Obviously, your entry when these stocks start to turn around, but what's going to be your signal to take some money off the table?
You start seeing action. I like to call it a sick patient. So the patient, in this case is a stock, once it starts getting sick. So a part of our process is a lot of people, they always ask me, where's the market going to be next year? Where's the market going to be tomorrow? I don't know what I'm going to eat for dinner tonight, let alone where the market's going to be in 6 months or 12 months. And no one knows where it'll be. So predictions, it's just like the weather. You don't know. But I live in Florida at this moment in time, and I can go outside. If the sun is shining, great. In the afternoon, it's going to rain. That's just how it is. So if there's a hurricane outside, like Hurricane Arthur that just passed, and you're trying to stay dry, and you see there's a hurricane outside, are you going to walk outside with an umbrella and say, oh, yeah, I'm going to stay dry? Odds are you're not. You're going to get wet. So it's the same thing here with the market. As long as the sun is shining, the stock's acting healthy, I'll write it and give it the benefit of the doubt. The second it starts getting sick, when you'll see it, you'll just start seeing wide and loose action. You'll see some heavy selling show up out of nowhere. Then you'll start seeing some technical areas of support being violated. Then you start seeing sentiment shift. All these indicators are saying, okay, time to take the profit. Now, if the market's acting healthy and the stock just happens to be one that's just pulling back, that's another sign that something's just awry. The stock's not participating in the rally. So there's lots of ingredients that go into the overall formula to say, okay, it's time to pull the money off the table.
Do you short stocks?
Absolutely.
Okay. And what do you just...
Not in a bull market, just as the caveat.
Okay. So you were given just some general market analysis here as far as, you can't tell where it's going to be today or tomorrow, but, just look for accumulation of different events. I mean, looking at this Netflix here, tight range on Friday, made that new all-time high, 475.87. Do you place a physical stop in the market, or are you just...
Absolutely.
Yeah? Okay.
Yeah.
Okay.
Yeah, so here's a few answers. Number one, I don't know what the market's going to do tomorrow or next month, but I do know what it's doing right now. And that's imperative for all of your listeners to focus on what's happening right now. The second point to keep in mind is define your time frame. I like to say, a lot of people say, oh, you're investing, or you're trading the markets. People say you're playing the market. It's important for me to, everyone has their own definition, but from where I sit, if you're an investor, you're more like Buffett. You're buying companies, you're not buying the stock. You happen to be physically buying the stock, but your mindset is saying, okay, I like this company, and come hell or high water, I'm going to own the stock. Buffett's stock, Berkshire Hathaway, has had 50% declines since he took over 50 years ago. Now, he never sold. But I don't recommend the individual investor to do that. But if that's your priority or that's the way you like doing business, then that's fine. But from a trading standpoint, if you're looking to actively trade stocks, you physically can't do that because a 50% loss will just blow you out, especially if you have a few of those. So the first thing I keep in mind is what are you? That's what I ask people. Do you want to be an investor or do you want to be a trader? And if you're a trader, the connotation is you're more active. If you're an investor, you're more passive. The third thing at this point, first of all, what's the market doing right now? What are your stocks doing right now? Then are you a trader or investor? And the third point is your time frame. If you are a trader or an investor, what's your time frame? Are you looking for dailies? Are you looking for weeklies? Are you looking for monthlies? Are you an intraday trader? ... So when you're able to define your time frame, then you can find trends that work within that time frame. So if you're a day trader, you don't care what the monthly or the quarterly or the annual charts are doing as much as you do is what's happening in the intraday or the daily charts. If you're an intermediate term trader like we are, then you care more about the weekly time frame more than the individual intraday or the longer term annual. But it's really important from us. We synthesize all three. We look at the daily, the weeklies, and then the longer term ones we just group in one category, which are the monthly, quarterly, and annual charts. So we always want to know where the market, what trend are we in? So if right now, clearly, we're in an uptrend. Anybody that argues with that is just ignoring facts. From where I sit, the underlying driver of this entire bull market has been the Fed. When QE1 ended, the S&P fell 17%. When QE2 ended, the S&P fell 21%. So now we're in a very tenuous situation. The Fed's trying to hand the ball off to the economy to see if the economy can stand on its own 2 feet. If it can, great, we'll keep going higher. If the market stumbles and we get that whole correction, 1,000 days since we had a 10% correction, then of course we'll see what the Fed will do. I wouldn't be surprised if they ramp QE3 back up or start QE4 if the market really gets in trouble. So that's something that really needs to be kept in mind. And the reason why we haven't had a correction, to answer the question, is because of the Fed put. And that's exactly what that notion means. When the market goes down, the investors know the Fed will step up and do whatever is necessary to help the market, and that's the Fed put.
And do you use options at all for your positions, or are you just straight using the equities?
We use options, not for fine leading stocks. We have a separate website called marketvalor.com, and those are options trades. We do long options and we do short options as well.
Okay. All right. We've had Adam Sarhan here, founder and CEO of Sarhan Capital. Runs a couple different sites here for asset management, RIAs, and then the little guy, the little investor. Well, Adam, thanks for coming on, sharing your insights on the market. We'll like to follow your predictions and hope to have you on again.
Pleasure. Thank you.
Okay. Thank you, Adam.